All right, great. I think we're about ready to get started then. So welcome everyone to our bot trading workshop and competition. I'm Stephen Grugett. I'm one of the co-founders of Manifold, and I'm joined by Michael Wheatley, who is the #1 bot trader on Manifold. So in case you're unaware, I run Acceleration, which is the house trading bot. It is the most profitable trader on Manifold if you exclude the non-predictive markets. But I cheat and I have a speed advantage because I am the house, and the resources of Acceleration go flow to and from the house bank account. Whereas Michael Wheatley is the actual #1 best trader competing fairly with all of the other ecosystem of bots that we have. So in this workshop at the end, I'll discuss the rules to the trading competition and help you get started setting up your own bot. If you'd like to zone out on everything that we're saying and just focus on building a bot, you can do that right now by going to the URL for the bot competition, reading the rules, and then you can clone the Git repository that I've set up that has a simple working trading strategy. But otherwise, we'll get to this in the middle of this session probably. For the first part, I'm just going to go over very simply how prediction markets work on the most basic mechanistic level. So the first question you might have, especially if you're coming from the forecasting space or don't have much experience in prediction markets or other financial markets, is like, what are they? And a prediction market, very simply, is a venue to trade shares on the outcome of future events. So many events are uncertain. Many people want to know if Biden will be the 2024 Democratic nominee. That question has a simple binary outcome: either he will or won't. If you fix the criteria of what it means to be the nominee, which we can assume that we can do. Sometimes there are edge cases. But for many binary questions like that, there are only two outcomes. And typically in a prediction market, we're trading shares on each of those outcomes. You're buying yes shares that pay out 1 mana or $1 if the market resolves yes, and no shares that pay out 1 mana if the market resolves no. So that leads to a very simple accounting identity at any point in time. 1 yes share and 1 no share should always be worth 1 mana. So if you ever have equivalent amounts, those net out and you have just your base currency. So the property of prediction markets that people care about the most is the fact that the price for yes shares is basically the probability that the event will occur. And the reason for this is that in an efficient marketplace, if we suppose if the market were currently trading at 25%, but the true probability of the event occurring were 50%, then you have a guaranteed way to make profit, which is to buy yes shares up to 50%, and then you will lock in whatever the price differential is for that outcome, assuming that you're right, that the true probability is whatever you say. So there's this extremely basic efficient markets argument that gets you to the efficiency and the result that prediction markets are calibrated. There are a few edge cases where the price per yes share and the probability are a little out of whack. A lot of those involve like the time value of money arguments. For instance, a couple weeks ago, one of the top markets on Manifold was whether the aliens unveiled in Mexico were real. So the price on Manifold did not fall direct to zero. It fell to like 2% or something. So part of the reason is that the 2% rate is close to the interest-free rate on Manifold. Or the risk-free rate on Manifold. You can go to in a market type setting, people have limited amounts of capital and they only want to invest in things. They want to invest in things that will get them the highest return as possible. So things typically, they don't converge to zero. They just converge to the best because you could go to other places and make more money. And the interest rate on Manifold, is dependent on the overall interest rate with the dollar and, specific dynamics on our platform. Some other reasons why there might be a weird, funky differential are ones where the condition of the market will make mana worth more or less. So one instance of that is, have a number of markets on whether there'll be extinction caused by AI in 2030. So in most of those worlds, the mana will be worthless to you because you will not be alive because you are human, which, will make the price issues a little funky. There are also issues if you're betting on the success of Manifold. If Manifold goes under, mana will be worth a lot less, so the implied prices probably will be higher than the true prices. You can think of a bunch of other examples too, where the incentives will warp what the true probability is. But for the most part, you can just think of the price, the price per yes share and the probability displayed in our markets being like roughly pretty good. So the next question then is like how does trading happen on prediction markets in general and Manifold in particular? So the first and simplest way to set up a trading venue is to have an order book. So an order book is just a series of limit orders, where a limit order is a statement that you want to buy yes or no shares at a particular probability for a given mana amount. So that sounds pretty complicated, but it's really quite a simple concept. On Manifold, you can see the order book by clicking this little percentage thing and the view orders. We did this to hide it from the noob users. It's a little bit of a power user feature, but here you can see all the resting orders on the book. There are 2 orders to buy at 28% and 45%, and 2 orders to sell. So what this means is this person, if someone executes a trade against them by betting no, they will get 45 mana divided by 0.45 yes shares. If the market resolves yes, then they will earn that in mana. And if the market resolves no, they will receive zero mana as a result. Through traders setting limit orders at various prices that that helps set market dynamics and is the mechanism by which market prices are set on Manifold. But as you can tell, like many markets, including this one, don't have that much liquidity. The spread between the best yes or like buy and sell price is quite high. And many of our markets are on smaller, more niche personal issues. So to get around this problem, Manifold uses an automated market maker to act as a liquidity source of final priority if there aren't any resting orders on the book. So an automated market maker is basically a very simple mechanism which has its yes shares and no shares inside of the liquidity pool as part of its inventory. When you talk to the automated market maker, what you're doing is you're giving cash or mana, and in exchange it's spitting out shares. And you can think of it as being like a continuous version of the process that happens when people are trading on order books. The automated market maker obeys some pretty simple rules. If you buy more of a given thing, if you buy more yes, the price goes up. The automated market maker doesn't lose its reserves. It only asymptotically approaches. If you keep buying more and more yes, there'll always be some small, infinitesimal number of shares in reserve for more people to buy. The quantity in its inventory never goes to zero. If you purchase, there's the independence clause. If you buy 10 mana worth of yes and buy another 20 mana worth of yes, that should be equivalent to buying 30 mana worth of yes. So any good automated market maker will obey all of these properties. And when you do that, the specifics of which curve you're using don't matter that much.
Sorry, what is the liquidity pool?
The liquidity pool is the inventory that the automated market maker has set aside for you to trade against. So the particular AMM that Manifold uses is based, not good, is based off of a Uniswap. So this was developed without any reference to prediction markets initially. Uniswap works by having, in the simplest case, like two liquidity pools. In a traditional asset case, it could be like Bitcoin and dollars. And then a very simple invariance property. So for each of the units in pool A and the units in pool B, you multiply those numbers together and that gives you some liquidity constant. And the magic of Uniswap is that everything that you do to transact with a liquidity pool preserves this invariance, where the shares in the first thing times the second thing will always be equal to the same number. So in a prediction market context, instead of Bitcoin and dollars, the inventory in the liquidity pool are yes shares and no shares. So the simplest version of a prediction market AMM uses the Uniswap rule to maintain an invariance between the number of yes shares and no shares in the pool. So a very simple example of this would be, suppose we start with 10 yes shares and 10 no shares in the liquidity pool. So we multiply those two numbers together and we get this liquidity constant 100. Every transaction that we do with the liquidity pool will preserve this property where when we multiply them together, it'll be 100. So the process of purchasing shares means you walk up to the liquidity pool, you say, I want to buy 10 mana worth of yes. So as we discussed earlier, there's this accounting identity where 10 mana is always worth 10 yes shares and 10 no shares. So what we do is we add both of those into the pool. So now we have 20 yes shares and 20 no shares because we started with 10 of each, and now we've added 10 from the mana. And now the invariance is broken. 20 times 20 is not 100. So the trade aspect is you withdraw enough shares from the liquidity pool to restore the invariance. So in this case, you would end up with 5 yes shares in the liquidity pool because 5 times 20 is 100. And the shares that you get in response for your trade is 15 yes shares. So in that instance, you'll walk away with 15 yes shares as a result of your trade. The invariance is maintained and more people can trade against the pool. The overall, you can read off the overall probability in the pool. It's the number. It is that since when you are purchasing yes shares, you are removing shares from the pool. So the probability as given by the AMM is kind of the opposite what you would think. It's the number of no shares divided by the sum of the yes and no shares. It works a little bit in the opposite way. So the actual AMM that we use for binary markets on Manifold is a little bit different. We play with the exponent a little bit to give us some other properties, but it doesn't really matter, and I'm not going to talk about that right now. But for the most part, you can assume that it uses this Uniswap style mechanism. So in practice, for most trading strategies that you write, you don't really need to understand the AMM at all. You just need to think about it conceptually as that there's this additional piece of machinery in addition to the limit orders that that provides you with liquidity you can trade against. Most trading strategies are not sensitive to understanding the details.
The way I like to sum it up in one line maybe is there's value in it. They want it to be possible to always make a trade at the displayed price. So what the AMM is going to do is it's going to say, I'm always willing to sell you yes or no shares. It's just the more you try to buy it, the worse the price I'm going to get you.
Cool. Yeah, so now I'd like to shift gears and focus on different types of trading strategies you can do in a prediction market environment. I've come up with a non-exhaustive list of quantitative trading strategies that you may know from real money markets, most of which are not being implemented. Only, I think, 2 classes of these strategies are currently in production on Manifold. the first and most obvious, class of strategies that you can use to make money right now on Manifold are very simple things which just look at simple price movements by traders. And typically those fall into two camps. Mean reversion strategies. If there are bad traders who make big bets, if you bet against them, that probably is going to be a pretty profitable strategy. And then the converse strategy of following good traders. If you see a good trader and they make a big bet in a marketplace, you want to follow them if they historically underbet. This class of strategies of like moving in the direction of trading are called momentum strategies. So this is what BotLab, the #1 bot on Manifold, does. At least the first class of strategies.
Funny you say 2 have been implemented. I've personally implemented 3 of these.
Mm.
My news trading bot shut down when Elon Musk shut off my API access to Twitter. And I had a time decay strategy, but it turns out that BotLab was a lot more profitable, so that fell by the wayside.
That's cool. Yeah, so these, so some other ideas that you might want to think about here. So market making is kind of a bad term because we also use that to refer to the act of creating a new question on Manifold. But which
is also lucrative, so people get confused when you say you can make a lot of money by market making.
Yeah, very true. The trading use of market making is posting limit orders to the order book to profit from the differential in the spread. So a lot of there aren't currently any good market making bots out there. So there is alpha there for the first person to implement a good variant of this strategy. Being successful in this domain requires good modeling of volatility in the markets. The next, I guess, like obvious category in of strategies in a prediction market setting is news trading. A lot of events are very news sensitive. If you're trading on a market of whether Biden will be the nominee, if there's a news story about how he stumbled down the stairs, is now a quadriplegic or something, you probably want to bet no. Or if you're trading on oil prices and there's an explosion somewhere, or I don't know, in some port in Indonesia, then maybe prices are going to go up, and you would bet higher on those things. We live in the era of large language models, so a lot of strategies now can be automated in a much easier fashion than they would have been before. You can even ask GPT-4 to help you predict what the sign will be, or whether it'll be good or bad for the marketplace before you do the order sizing yourself. But there is definitely some quant alpha out there for good news trading bots.
Steve, you told me you worked on one of those and never launched it. What was the stumbling block?
Yeah, well, mostly time. So this was actually a hackathon project a few months ago. I was trying to combine a news API, I think it's literally called just newsapi.com or something, with GPT-4 and the Manifold API to create a thing that trades off of news. So the basic setup there was going to be that it would just stream, or I had a list of pre-programmed markets to listen to, so some stuff about Elon Musk and other big trending markets with a lot of liquidity, and then it would just stream in all of the news headlines as they came in, and ask GPT-4 if this headline was very related to the news story or something, and then if it was, that it would place a really big trade. It's hard to get. I think this strategy would work. You have to get all of the details right though, where you're not misfiring in response to seemingly related but unrelated news stories like Elon Musk's girlfriend Grimes comes to manifest would not, move the price on a SpaceX launch, presumably. Things like that. But I think this is doable to someone who's willing to put in the time, and would be a cool demonstration of a powerful prediction market strategy. So the next category of things is in trader speak, people call this theta, but it's time decay. So many markets are structured in the form of will X happen before the end of the year, before 2025? So conditional on X happening not now up to now, you can be slowly bidding down the probability of those events over time. You can write some trading strategies to do that and exploit this. Are you running any of those in production now?
No, like see, I had one, and it was pretty simple. It said, no trades have happened in a given time period, just headed in the right direction. But on Manifold, since the questions are user created, there's a lot of bizarre edge cases. Like the thing will sort of happen, and we don't know the subjective judgment of the market creator. So my bot would keep betting it downwards. So it would profit on 9 times out of 10, but it would just get so blown out the last time that you need to have lots of safeguards and edge to handle the edge cases.
Yeah. Cool. Then, so one of the next big categories of strategies, some of which are on Manifold now, are relative value strategies. So the simplest one are pure arbitrage strategies. So it turns out on Manifold, we actually have many duplicate markets that literally have the same resolution criteria by different creators, or even the same creator. Sometimes it happens. In that cases, you can do a pure arbitrage by betting no on the higher price one and buying yes on the lower price one and capturing the spread between those two markets. So I believe we have a few arbitrage bots in production today which are doing this right now.
We have about 6. It's nuts.
Wow. Okay. Yeah. And they're pretty profitable too, right? Or at least, or like the top ones are our bot is the fastest.
Yeah.
Yeah, so I guess that's a kind of a competitive space. Not so much alpha in pure arbitrage, even on Manifold today.
I think part of the appeal is it's hard to exploit an arbitrage strategy. Like it's hard to, with our bots, you could place a huge bet so acceleration follows you and then immediately sell and get some free money. But how do you exploit an arbitrage bot if it's looking at a spread and bridging a spread? It can be done if it's not the same at all.
Yeah. Yeah, so the more promising category is like statistical arbitrage. This is kind of also true in like real money markets as well, where pure arbitrage opportunities are pretty rare. Statistical arbitrage is just what it sounds like, something or like an arbitrage that exists like some percentage of the time. So typically, the simplest stat arb strategy that people talk about is pairs trading. So instead of having two markets that are exactly the same and resolve it in exactly the same way, typically you look to see if the spread between the two assets is co-integrated. So co-integration is different from correlation. You're looking to see if it reverts to a constant number. So if the spread typically is around 3 and there's a long track record of that being so. There are a number of statistical tests you can do to look for that. It's called like the Dickey-Fuller test. You can look that up. But the alpha on Manifold is like taking some very like basic pairs trading stuff, maybe doing it in an automated fashion where you use like large language models or vector search to see if the questions are conceptually similar, checking to see if their prices are or the spread is, co-integrated, and then writing a simple thing to like trade against those. I believe this can be done at scale in an automated fashion today, and I think this probably would be one of the most profitable things on Manifold that no one is currently doing. I definitely don't have the time to do this, but maybe some of you might. I think it would be a lot of fun too. The last simple class of strategies that you might consider on Manifold are like you can call them carry or yield farming strategies. So in traditional asset markets, a carry strategy, not that carry, is one where you basically borrow a currency in a low interest rate, low yielding environment like the yen, and then invest it into a high yielding currency like the Thai baht or like the Vietnamese dong or something, and you capture the interest rate differential. So on Manifold, we have a lot of markets which are basically certain but can't trade to 0 or 1 because of capacity constraints. Sometimes despite being certain, there are differences in interest rate between those. So the strategy here is to just find the certain or certain-ish market that has the highest like interest rate, and then like dump a bunch of money into that. So if like the Mexican aliens market is trading at like 5%, that's pretty like far above like what the true risk-free rate should be is. So just like buying a bunch of no shares in that will push it back down to the the interest-free rate, and you capture that differential. You can automate this strategy by looking across the universe of markets which basically already, their condition has already been met, and then like moving your cash between those different things. So this is a non-exhaustive list of some types of quant alpha that are available on Manifold today. The other point I want to mention is that Manifold is lit. It's lit in both senses. Yes, it's a really cool platform. It's great, but it also is lit in that the identity of all traders is known. So you can actually see when good traders and when bad traders are betting in particular things. That can help you avoid adverse selection in your strategies by not taking the other side of trades of people who are known to be really good traders, and conversely levering up if you're trading against bad traders. In my bot acceleration, I have like a number of flags where I specifically check for specific traders who are known to be terrible, and also for people who regularly trade on groups that are known to have like very poor performance, like Destiny. Cool. So I think we're about. Oh, do you have any comments? We're not going to shame anyone here.
So you actually have a flag that says if they're a Destiny trader, bet more against them?
Yes. Yeah. This is a real thing.
And do you have reason to think that carries more information than just their profit record?
Yes. I'm not going to give out any other details.